afternoon. We are here from Rutgers University, and we're here today to talk to you about Cognizant. So for Cognizant, we have a strong buy recommendation based off our 34% upside to our 2019 target price of $95.63. Cognizant is a market-leading technology consulting service provider based out of Teaneck, New Jersey, with a focus on digital operations and solutions. The four largest revenue-generating market segments in order are financial services, healthcare, products and resources, and communication, media, and technology. Currently, the business model generates the majority of the revenue from North America, while the majority of its cost base is in India. In today's dynamic environment, there's an urgent need for companies to have the ability to quickly and efficiently shift their strategies. To further accommodate those needs, companies have been highly motivated to transition towards all things digital. Cognizant is at the forefront of such digital initiatives, so combined with the aforementioned four market segments and Cognizant's recent acquisitions, we have a predicted 2018 revenue growth outlook of 8.1%.
We came up with a strong buy recommendation for Cognizant based on the three main factors: growth strategies, robust cash flows, and strong competitive positioning. Cognizant has been proactive in moving towards potential markets, Europe and Asia Pacific, and it had invested around $1.6 billion in the past 3 years, acquiring 14 companies. This helped Cognizant in bolstering its healthcare offerings and improving the digital expertise. M&As to add up to around 2% to the revenue growth going forward, which would support the earnings in the near term.
Cognizant is coming up with 6 key strategic initiatives in order to gain market share. They include aligning its digital solutions and services and also scale them up geographically as well as across various businesses. At the same time, they do not want to give up their core or their domain expertise because it's on the core that the new digital will be formed. At the same time, they will be supporting this with a global delivery model and a customer-centric collaborative approach. We believe that in this, through our primary field research, the digital has gained momentum in the past few years, and Cognizant with these strategies is in the right direction in order to capture those exponentially growing markets.
Moving towards the next factor, strong balance sheet allows the company to maintain financial flexibility while driving substantial returns to the equity shareholders. As you can see from the graph, Cognizant has been persistent over past 5 years, maintaining strong cash balance, leading it to have highest cash ratio of 1.62% among its peers.
As a service company, Cognizant has minimal physical asset requirements, zero inventory, no supply chain management, and with a CapEx margin of only 2%, this company has very low operational risk. With a cash balance of $1.2 billion and a current ratio of 3.1, this company is also extremely liquid. With a shrinking debt balance and an EBIT to interest expense ratio of 117, this company has very low chance of default, and it has the benefit of being seen as a low credit risk. In fact, perhaps the most important event in the past year was Cognizant's debt restructuring. While Cognizant was reaching the debt-to-equity limit in the previous covenant, this new credit agreement allows for higher leverage and therefore provides Cognizant with more flexibility in determining its own capital structure. While interest rate is higher under this new credit agreement, the company will not have to make interest payments throughout the first year. Cognizant's main focus on restructuring their debt was to gain more control over their capital. And with the added bonus of zero interest expense through the first year, we see this as beneficial to the company's operations.
One of the strongest moats that Cognizant holds is its strong competitive positioning. With a diversified customer base, we believe strength of its customers adds to the strength of the company. With a high client retention ratio of more than 90%, it ensures its growth improvement strategically and tactically while placing it one among the top 10 major players in the market.
We analyzed several pricing ratios to determine Cognizant's price within the market and believe that the EV to EBITDA multiple is the best representation of this company's value. Here, enterprise value represents the underlying value of the company, while EBITDA acts as a proxy for free cash flow, but serves to eliminate the risk of cash flow volatility. These pricing ratios demonstrate that the company is currently priced as a value stock, while it falls in line with industry comparable valuations. This is all while it maintains the characteristics of a growth stock. This cheap pricing makes the company a cheap buy with the characteristics of a growth stock. Revenue has been very strong in the past 3 years at 13% CAGR, while profit growth has only been 1.5% per year over the same time period. Rise of legal expenses, currency exchange losses, and high effective tax rates have led to diminishing profit margins. Moving forward, we do not foresee any material impact in legal cases and expect the legal expenses to continue to diminish over time. While many foreign currencies have continued to be volatile, we see much, especially in the Indian rupee, we see much less material impact. Finally, we see a significant reduction in effective tax rate of 43% in 2017 to just 26% moving forward, which is on the high end of company guidance. Taking all this into consideration, we see strong profit growth of 9.4% CAGR through 2022, driving the value of this stock.
Now, how do we get to our implied value price of $95.63? We use an equal weighted blend of a discounted cash flow technique and enterprise value multiple technique. We chose to use discounted cash flow technique because of management's intent on redistributing free cash flow to the equity investor. They announced in 2016 that they would have a $3.6 billion capital redistribution plan, and we feel that if we could accurately model out the free cash flow growth and discount it back to present value, we can get an accurate assessment of the price. We chose to use the enterprise value multiple technique because we wanted to get a sense of how the market was valuing a company like Cognizant. We felt it was a reliable ratio that accounted for Cognizant's strong debt position. We ran our model through a three-pronged probability tree approach with a 27% downside that represented a 2019 analyst estimate of a recession. Our 23% upside represents our view that the economy is in its later stage of the cycle. And here on the right, you can see the sensitivity analysis of our model. It's important to note that our best case bull represents 190% upside, while our worst case bear represents a 66% downside. Because the terminal value represents a large portion of our price, it's important to understand both the terminal growth and the WACC assumptions. For terminal growth, we got to a number of 3.92 using a nominal GDP within each region of Cognizant's revenues. We then allocated that pro rata to what we felt the revenues were going to be going forward. For the WACC, we got to 7.31% based on management's guidance of the debt-to-equity ratio, not necessarily the debt-to-equity ratio on the balance sheet. We used a conservative 26% tax rate and a 1.12 beta that's in line with industry standards. Now, where do we differ from management's assessment? We felt that within the first 3 years, it would take a little bit longer to gain traction from the M&As. We took a more conservative approach in both the revenues and the costs, and as seen here, you can see the differential. After these 3 years, we fall back in line with management's assessment.
Like any other company, Cognizant faces enterprise risk, the most important one being the political risk. Considering Cognizant is the biggest sponsor of H-1B visas in the US and the current Trump administration imposing restrictions on the immigrant visa workers, we see that it gets starved the company from the need for the various IT professionals. At the same time, the attrition risk, which is the highest for Cognizant in the industry at 22%, Cognizant has been taking steps to address this, but we are yet to see effects of those. The other set of risks that we foresee is the market risk, especially the foreign exchange risk, arising due to the fact that 70% of its expense base is in India, and any volatility between Indian rupee and USD can affect its operations. The other factor is the macroeconomic risk, which we believe will affect Cognizant indirectly because the customers might get affected due to the events like Brexit and trade wars. The other set of the risks, we considered them at lower end, including management conflicts that might arise due to aggressive acquisitions that it has been doing, and the competition in the industry. We consider them at the lower end because we believe Cognizant has been in the industry long enough to take care of such risks. And of course, we will never advise you to invest in a company that doesn't have a good board. We give 9 on 10 on corporate governance to Cognizant. The only area for improvement we suggest is to add more independent board members so that they can reach the advisable norm of 75%. Also, we believe Cognizant is a sustainable company with its ESG score lying around 85 percentile. So we believe it is in a good position to tap into the increasing impact investment market. So we give a very strong buy to Cognizant because of its growth strategies, very robust cash flows, a very strong competitive positioning, and our analysis of its solid upside potential. Thank you.
Hi, thank you for that. I've got a quick question regarding the competitive landscape for Cognizant. Can you talk a little bit about what you think their core competitive advantages are against some of their competitors, which happen to be quite a bit larger than Cognizant? And also, if you could include in the answer the competition for talent, since that's such an important part in the IT industry.
Well, for Cognizant, one of their where they stand out is their customer approach. They boast the highest retention ratio of around, last I checked, 94, 95%. And one of the issues with that is they have to spend a large amount of money to retain their valuable employees. They also have a strategy called Box and Two, where they kind of get in the trenches with the company and treat it as if it's their own, and the company respects that, and they have a lot of very reoccurring contracts because of that.
With the talent retention, they're actually trying to bring up more regional development centers in order to develop more skills and also get into employee engagement programs, whereby they're trying to ensure that the attrition rate, which is currently high at 22%, it goes down, and they're able to cater to the digital market with those talent employees.
How realistic are the EBITDA multiples resulting from your base and bull cases on the DCF relative to the multiple at which the stock has traded throughout its history?
So you're saying how is the differential between the EBITDA multiple and the discounted cash flow, or in relation?
So your bull and base case imply 25 times or 19 times EBITDA, right? What has been the historical range for the EBITDA multiple over Cognizant's trading history?
Historically, they have not been that high. We've predicted an inflection point in the stock based on the movement towards digital, and the CAGR for the past has been around 1-2% for the past 5-6 years. We predict that to take a hockey stick move and go around 8 to 9% going forward.
Okay.
Okay. When looking at the price of this stock in the past, let's say in the past year, it's been pretty stable and close downward sloping. Why do you think that in the next year could take that up peak? Or what do you think that are the key elements that would take that the stock price to go up to 95, 96 close?
They have very strong contracts with the customers, and they have really long-term contracts, and most of the customers give extremely satisfactory thing. So, and also one more thing is that they're trying to move towards healthcare services and digital, and they've acquired SaaS Focus and Boulder last year, adding up to their earnings, and we believe that would be one of the main advantages. Moving towards the digital would be the factors for the long.
Another factor is Cognizant one of their goals has been to expand their market share internationally. So in the last 12 months, out of their 8 acquisitions, 4 of them have been overseas, and they've all been looking to expand upon their footprint in those different countries.
And moreover, they have been trying to move their revenue towards a higher CAGR segment, which is a CMT. So they're moving to from financial services to the communication, media, and technology, which actually had major growth in revenue compared to the others in the last quarter.
How would you address the premise that the labor cost arbitrage model may be running its course with higher wage costs in India, higher turnover of employee tenure? I mean, is it conceivable that the better players like Cognizant see their margins eroded away into the mid-teens, perhaps on an operating margin basis?
Well, actually, the talent in India, of course, we have the reason it's there is, of course, the cost reason. But we do see, with the digital coming in, the cost of the talent is more. But at the same time, the revenue that will be generated from the projects will also be more. So there will be a trade-off like that for the talent and the revenue model. So that way they'll be able to maintain their operative margins with the new digital domain that they're trying to explore.
Additionally, Cognizant spends a lot of money on client retention, as we were saying, and they have the ability to, through these long-term contracts and escalators, they have a very sticky relationship with their clients. And the top 5 clients are in very strong sectors. So they have the ability to, if they need to increase the cost of a contract due to compensation to their employees, they have the ability to pass through to their customer.
On board independence, is the CEO on the board?
Actually, the CEO now is not on the board. Previously, there has been a change of CEO since 1st of April. Earlier, the CEO was the vice chairman of the board. So at this point, the CEO is not on the board.
Would you talk about management's compensation packages?
I'm sorry?
Management compensation packages.
They're basically, they have cash base, and then they have performance stock units and restricted stock units as part of their compensation. Yeah. As you can see here, this is from the 2017 proxy report, whereby they have been providing the performance stock units as well as the annual cash salary for the management and the non-executive officers.
With the introduction of dividends a couple years ago, buying back stock, now at a far greater clip, could that signal, that shift in capital strategy? Does that conceivably, signal some kind of a shift toward a change in the business?
So the CEO just recently mentioned that they have a structure in place whereby the free cash flow generated, 50% will go to the capital redistribution plan, 25% will go to ongoing operations, and 25% will go to M&A as needed. So they have a little bit, and with the debt restructuring, they have a little bit more flexibility to attack and gain M&As if they need to in that space. So.
Given the company's offshore model, they're a big user of the H-1B visa program, one of the biggest in the tech industry. Can you talk about how they're mitigating the risk on the immigration side?
Yes, Katie Royce in her last interview, she mentioned that they're coming up with regional development centers, not only for developing the skills, but also it caters to this aspect whereby they develop the local individuals with skills that are needed in the industry. At the same time, not only providing, they can move from offshore to a near-shore kind of an environment, for example, placing people in Mexico that go with the sun and cater to the clients according to the needs. So these are the two aspects whereby they're catering to it. Moreover, with the digital, whereby they suggested a global delivery model. That's the global delivery model aims to actually cater to this, whereby they can have the US people in the project on the client side, while some are offshore and nearshore.
What kind of change in share count did you model going forward?
I'm sorry?
What kind of change in share count did you model going forward?
So in terms of the share count, they were buying back stock. It has been accretive to earnings. The change year over year has been very, very limited. And we modeled that too.
Okay.
When comparing your projections with the management projections, when you build up the free cash flow, that you mentioned that you were a bit more conservative on revenues and a bit more also conservative on the cost reductions. Why, when I saw the number for 2020, I saw that your difference was like almost double than the previous year, and why is that a specific year the one that you are targeting for the reduction in, especially in SG&A?
Sure. So they've had a lot of M&A in the past, and they've had a lot of recent M&A. And historically, when we looked back at the M&A and when they started realizing it, and when management said they would start realizing it, it was a two-year delay. And they recently, the past year, have made a large push to make more M&A, to go after more targets. So we applied that same 2-year window looking forward that we did looking backwards.
The debt's pretty unusual. Having a 1-year waiver on it, was this a negotiated situation? And on top of that, what's the rating?
They have a AA- rating by Egan Jones. They worked very hard to restructure their debt in a way to gain more control of their capital. So yes, the interest payments for